every single morning at the moment. China, China, China. Live from New York City this morning. Good morning, good morning. Your equity market's slightly negative. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York City, coming up, posting the first back-to-back gain since July. A week filled with jobs data just around the corner, and China pledging to speed up fiscal spending. We begin with the big issue, a problem for China or for all of us.
If you look at what's going on in China,
what's happening in China is a challenge.
It's structurally just challenged.
Clearly, they're having some issues.
There was actually a lot of positive sentiment going in.
China has been a disappointment, no question.
Every time China tries to stimulate, it just fizzles. It's a big concern about whether or not that gets exported to the rest of the world.
It's like the butterfly effect.
There's a relationship between China CPI and the U.S. CPI.
It's going to be a deflationary pull through across global economies.
I also look at China through the lens of being deflationary for the global economy.
The China news is worse for Europe than for the United States.
Europe is more exposed to China than the U.S.
The U.S. economy is on thin ice, and frankly, the global economy is on thin ice.
It's a very complex environment wherever you look.
We're dying from 1,000 paper cuts of stimulus here, and frankly, it's just not going to be enough to change those structural forces.
Your team coverage starts right now with Damien Sasser of Bloomberg Intelligence. Anne-Marie down in Washington, D.C. Damien, another morning, another policy effort. What next?
Does cutting mortgage rates on $5.3 trillion worth of mortgages actually do it? That's a question we're going to be asking ourselves. My bet is, alongside Matt Mishkin, it will not. The real issue, as we mentioned earlier, Jonathan, it's about that fiscal deficit. How do you get the money to those who need it most? The fiscal deficit in China has fallen 33% year over year over the first half of this year. You know, it's $477 billion. So basically, where's it going? Where does it go? How does it get there? That remains to be seen.
Check out this for a line from the Commerce Secretary saying that she hears from businesses that China is, quote, uninvestable. AMH, you've been following that one. What's the latest on that 4-day trip?
Well, what's going on is you see the U.S. really trying to smooth over some of these tough tensions between Washington and Beijing. They've sent previous officials, and now it's Raimondo's turn, the Commerce Secretary. And, John, I want to point you to the quote she said to China's #2 official. She said, President Biden asked me to come here to convey the message that we not seek to decouple. We seek to maintain our $700 billion commercial relationship with China, and we hope that relationship can provide stability for the overall relationship. She's really trying to hone in on what these two countries share in terms of their commercial ties, their investment ties, their trade ties, not when it comes, she says, to national security. She says there's still growth in this relationship, really trying to smooth over what is going on in terms of the tensions that has happened between China and the United States. One thing is unclear, though, yet. Will she leave having sat down with Xi Jinping, or potentially that one's going to have to wait?
Well, before she exits, she's got to deal with this awkward headline. What do you make of this, Anne-Marie? Putin, the Russian leader, agreeing to visit China in the first trip since his arrest warrant.
Well, I would not be surprised if Putin goes to China. Remember, Jonathan, you have Putin and Xi Jinping for the last few years saying that they have this relationship that no one can stop. We have seen them grow very, very closer together. And what you've also seen, given Putin's invasion of Ukraine, given the fact that Europe has now shunned oil and gas coming from Russia directly into Europe, Russia has basically come, and this is a quote from a Russian official speaking to the Financial Times, a penal colony for China. China is able to get all their resources on the cheap coming from Russia, and that is a relationship that looks like it's going to last.
AMH, thank you. Anne-Marie, the latest down in Washington. Damien Sasser, thank you, sir. Just effort after effort from China at the moment. Over the weekend, cutting stamp duty on stock trades, leaning on funds once again to buy more stocks than they sell. This morning, we're talking about cutting deposit rates, mortgage rates, leaning on fiscal policy a little bit more. All of this happening with the Commerce Secretary in China at the moment for a meeting with officials over the next few days. And then this headline drops that the Russian leader has agreed to visit China in his first trip since his arrest warrant. Talk about awkward at the moment. Let's talk about this economy and what it means for this market. Joining us now is Aberdeen's Luke Hickmore, Mike Kontopoulos of Richard Bernstein Advisors. Luke, I've got to ask the question we started the programme with, and great to see you both. Is China's economy their problem or a problem for all of us?
Ultimately, it's a problem for all of us. We've seen European economies slow down quite significantly off the back of this Chinese slowdown. America maybe is more immune to it, but ultimately as we go through time, it will affect them considerably. And, you know, this shifting around of manufacturing bases out of China into reshoring and friendshoring, because of Chinese actions to this point, is going to have a massive cost for every single economy over the next 5, 10, 15 years.
Mike, would you agree with that?
I mean, China is definitely important in terms of, world commerce and worldwide growth, particularly Europe. But let me shift direction for a second here, Jonathan. I mean, isn't China looking a lot like the United States in 2008 and 2009? And what was everybody saying about the United States, 15 or so years ago? That it was uninvestable, that there was no way it could be the leadership in terms of the stock market, that everybody had to invest in EM in Europe at the time. And that proved completely wrong. And one of the reasons why is because of a really hard lesson for some people. You don't fight central banks. You don't fight the Fed. You don't fight the ECB. You don't fight the BOJ. So when I hear about this, economic data that's coming in weaker than expected, to me, it says the PBOC at some point is going to unleash some sort of bazooka stimulus. And that's going to be, generally speaking, good for global growth, good for the Chinese economy, good for Chinese equities, actually. And so I would take maybe a little bit of a different spin. It's everybody wants to run away. That's probably the time you're supposed to be getting more bullish about the economy and about the stock market there.
You're not alone. Chris Ferro, Stratega, said the same thing, something similar earlier this morning. And he pointed out iron ore. Look at iron ore. It's not breaking down. It smells the scent of something. So, Mike, let's say you're right. Let's say that this time is not different. They come out and do something big. Where do you want to be? How do you want to be positioned?
Well, I think across all asset classes, Chinese equities look pretty attractive. You've got one of the cheapest major markets in the world. I think it trades at about 11 times. That is, outside of Latin America, the cheapest market out there. More importantly, you actually have positive earnings growth. So if you look at actually Chinese equities, remember when you buy stocks, you're buying the earnings stream of those equities. And actually earnings, you're not buying the economy, right? You're buying earnings, and earnings growth in Chinese equities is actually accelerating, right? Whereas the rest of the world may be bottoming, but in China, they're actually accelerating. And then you've got great liquidity coming from the PBOC. And so, I think you want to take advantage of a cheap Chinese equity market. And what you can do is you can kind of pair that cheap China equity exposure with U.S. Treasuries. Because at the end of the day, if that view ends up being wrong, it'll be clearly negative for global growth. And the U.S. Treasury market can provide a really nice and relatively cheap hedge today to compensate you if global growth does slow on the back of China and we're wrong.
Luke, I wish I had a camera on you while Michael was talking. I was trying to work out if you were just sitting there shaking your head. Are you sitting there shaking your head, Luke?
Shaking his head, yes or no?
Not entirely. Exactly. Not entirely. I mean, let's remember who got us out of the GFC in 2008-9. It was China, and it was China with a massive stimulus package, as well as the Fed and everybody else. But China was in there buying U.S. Treasuries. They were in there stimulating their economy. It drove global growth forward at a time that we most needed it to happen. That's not where we are with China right now. They are struggling to commercialize the internalization of China to be more domestically driven. They're struggling to cope with people moving their manufacturing activities outside of China. And yet there's still plenty of places you can find growth, as there always are in every single market in the world. But I think as a broad beta play, China right now just doesn't look as attractive to me as, say, a Latin America, as actually in America, but an America that's probably 6 months, maybe 8 months away from having to cheapen up and actually become attractive again as an investment. Right now, I'm struggling with equities almost everywhere. Maybe that's because I'm a bond investor. That's the kind of default starting point for me. But it does feel to me, when the American market's expensive, everything's expensive. And PEs in the US market, in the S&P 500, are way out of kilter with where we are in the growth phase. So ultimately, China may not matter. It may come back down to how do we value the S&P properly and actually correct it through this autumn.
The equity guys come on and talk about bonds all the time, Luke. The bond guys are allowed to talk about equities once in a while, so we can do that here. Luke, I want to build on something you said about China, and it comes down to policy. When I listen to both of you, and when we assess policy, you have to do two things: ability, willingness. Is it about an inability to respond to this, or an unwillingness to respond to this, Luke, from your perspective?
China have got an almost unbelievable array of tools that they use, and that may be part of the problem. That we all complain about the hammer that central banks in the West have. It's really just about interest rates that they can control. China have got a massive amount of tools. So I don't think it's the tools which are the problem. It's the desire to make a big enough change to actually shift the economics. And Mike might be right. That might be coming. There's not been enough signs of it yet. As you say, it's been incremental rather than we clearly need to do something to change the direction of this economy. I'd like to see that happen. So far, there's been little evidence they're going to do it in enough size.
Mike Kontopoulos, final word.
Yeah, I mean, I agree with Luke on that. I mean, we haven't really seen, the bazooka, so to speak, yet. It doesn't mean it won't come. They certainly have the tools to do it. And so, I think you're supposed to respect, central banks. And, you're getting paid in China to take that risk. And, that's always the question you get asked is, well, will the Chinese government do what they need to do to stimulate the economy, to support capitalism in the equity markets? And the answer is we don't 100% know, but that's why it trades at 11 times. And at the end of the day, earnings growth is accelerating, and that makes equities attractive there.
It was nice not to talk about the Fed for 11 minutes, but in about 2 minutes' time, we'll do that. The Federal Reserve, the ECB, the jobs market, and the Treasury market specifically. Mike, Luke, stick with us. Thanks for being patient. Your equity market on the S&P right now, slightly negative, down by almost 0.1%, with some movers going into the open. Here's Abby.
Beneath that relatively flat surface, John, we do have some outsized movers, although Best Buy well off of its highs on a beat and positive color quarter. The stock had been up closer to 5% earlier, now up 1%. Not bad, though. And again, a solid beat there. And the company is saying that a painful sales slump in electronics is over and that next year they might actually see some stabilization and growth. Now, VinFast Auto, to me, this is the least known large cap market cap company, the EV maker out of Vietnam. Bigger market cap than both Disney and Goldman Sachs, while giving some of it back today. It's not entirely clear why, but this stock has been up about 700% over the last year since going public. And then finally, Salesforce.com down 1.6%. They report tomorrow. Ahead of this, JP Morgan is cutting the stock from its focus list. Not a huge vote of confidence, John, I would say, ahead of that report. They're saying that all of the catalysts that could help the stock go higher, well, they're already priced in.
Abby, thanks for that. Just to get you up to speed on our latest reporting here at Bloomberg, I'll share the story with you verbatim. The lead paragraph reads as follows. Russian President Vladimir Putin has agreed to make his first foreign trip since a warrant for his arrest on alleged war crimes was issued by the International Criminal Court. The Kremlin is preparing Putin's visit to China for the Belt and Road Forum in October. This according to 3 people with knowledge of the matter who asked not to be identified because the issue is sensitive. The latest reporting here at Bloomberg. Coming up, a week's full of labour market data.
Everyone's been surprised that we've been so resilient up until this point. We're actually forecasting an employment report on Friday that probably looks like the Fed's ideal slowing of the labor market.
The appetizer for the main event, payrolls Friday, just around the corner. That conversation up next.
We're actually forecasting an employment report on Friday that probably looks like the Fed's ideal slowing of the labor market. It's just been amazing that jobless claims are still so low. We still have around 9.5 million job openings. That's about 2.5 million higher than pre-pandemic. It is still a very strong, tight labor market.
The payrolls report just around the corner, a week full of data. Here's the lineup, the calendar for you. JOLTS data, 10 a.m. Eastern time today. ADP payrolls report on Wednesday. Jobless claims on Thursday. The data painting a clearer picture of the Fed's path if job openings and labour force participation hold steady. Mike McKee joins us for more. Morning, Mike.
Good morning, John. It is a very busy labor week, and the Fed is going to be looking at a lot of these numbers that may tell them if they are continuing to make progress in slowing down the economy. Now, take a look at this first chart I brought along. It includes total job openings, jobless claims, the unemployment rate, and average hourly earnings. It looks a little bit busy, but the important thing is on the right-hand side, all of those lines are going down. And if they keep going down without crashing, then that is good news. It suggests the labor market is loosening a little bit. Don't sleep on the other data this week, though, John. We've got personal income and personal spending coming up on Thursday, and that's going to make a big difference to the Fed as well. They want to see if Americans have backed off on spending, and that's not the forecast. The forecast is for a 0.7 gain, up from 0.5. And then, of course, we have PCE inflation, and that is going to be very important for the Fed. Both of those numbers, as you can see, expected to rise a little bit. ISM manufacturing, normally a big number, comes at 10 o'clock on Friday after jobs at 8:30, so it won't get the publicity, but it will get some attention down at the Fed, as will payrolls. And that's the big number of the week, as we mentioned. And what we are looking at is a slower pace of job creation. Now, the Fed thinks we need about 100,000 jobs a month or a little bit less to absorb new workers coming into the labor force. And they would see that as a kind of a neutral level. But you can see we're still above that red line there, but it is coming down month after month. So we are expecting a drop in this latest number from August, and we'll see if we get it.
They call it further signs of progress at the Federal Reserve.
Signs of progress.
Mike
yes.
McKee, thank you, buddy, for the update. Looking forward to Mike's coverage. Job openings a little bit later this morning, then on to payrolls on Friday. The two bookends of a week full of jobs data. Luke Hickmore, Mike Contopoulos back with us. Luke, question for you. Has Chairman Powell done too much or just enough?
Yeah, I think enough. It's always difficult to say it's too much when we're still in this point of the cycle where, jobs are still plentiful and the job market remains tight. I think we are seeing enough signs of slowing growth, and the revisions are coming through pretty negative as well for previous months' non-farm payrolls, that we've done enough. And now it's getting into that, how long do they pause before we start cutting? Probably second half of next year at some point. That, for me, is going to be where the market shifts to. It may be that we get another 25 basis points. I suspect not. I suspect he's keen to have done with that and to move on. But, the economy has remained considerably more robust than I thought and most people have thought for the last 6 months to 8 months.
Well, to that point, Luke, there is a third option. Too much, just enough, or Mike Contopoulos, not enough.
Yeah, there's definitely a risk to that, Jonathan. I think when you look at the data, it certainly has surprised us in terms of, remaining resilient and maybe even looking like it's forming a bottom. I mean, I think the jury's still out as to the ultimate direction of the economy and labor for that matter. But certainly has been better than most would expect. And you could easily construct a situation here where growth starts to reaccelerate, inflation starts to reaccelerate as profits start to reaccelerate. And I think that's something that I'm not saying is our base case, but is something we're very attuned to because earnings cycle has bottomed. I think that's pretty clear. There's not a huge inflection upward of the earnings cycle, but should that happen, which is what typically happens during most profit cycles, then you can easily make a case that accelerating profit growth in a tight labor market ultimately leads to higher wages. And the Fed gets caught off guard here and you get an increase in inflation pressures. And so, I'm not sure that happens or not, but it's certainly a big enough risk that I think it warrants some balance to a portfolio to make sure that you're hedging that potential.
Well, this raises a question for two fixed income guys. Let's talk about that, Mike. Let's say that plays out, reintroducing the risk of higher for longer or maybe even just higher at the Federal Reserve. If that's because the data is better, earnings are more buoyant, the economy is stronger, and maybe price pressures are lingering, is that good or bad news if I'm a high yield company right now and I've got to issue debt next year and I haven't issued debt for a while?
Yeah, I think I've been in this camp for a while and, I've had moments of being right and a lot of moments of being wrong on this in the sense that corporate credit just looks way too rich. I just don't see the benefit of owning, whether it's high yield or investment grade corporate credit here. Spreads are so tight, you're not compensated for any sort of uncertainty. And as rates continue to go higher and companies need to refinance, obviously that's happening all the time in the loan market as rates float. But in the high yield market, as basically companies come to market and issue new debt with much higher interest costs, unless their earnings are accelerating to a much higher degree than rates are going up, there's going to be a lot of pain in high yield. And so, I just don't think you're getting compensated there. There are other areas of the fixed income market that have sort of realized their event that would maybe make a bit more sense. But high yield leveraged loans, in our view, are not two of them.
Luke, I'm not sure we've had that interest rate test in this country yet. This test of this economy. Let's think about the housing market. That's not come through at all. If I'm on a 2% mortgage, I'm not selling. And if I'm facing the prospect of a 7% mortgage, I'm not buying. That part of the economy is just seized up. As for high yield companies, they issued years ago. They lengthened everything out. They're in a strong position. The refinancing test, Luke, of next year, maybe beyond. Have we had that test yet? That test of 5.5% interest rates of this economy?
No, absolutely not. And there's another organization here that we need to talk about as well. The US government, the federal cost of interest is going up dramatically. Now, they're one of the few people who have not turned out their debt. The amount of debt they've got coming due makes them look like the worst high-yield company out there. There is a wall of maturities coming for high yield, a wall of refi, I should say. It is probably over the next 2 years rather than it's any immediate problem. And I agree with Mike. I'd be out of high yield apart from one or two special situations. I think there's better value in investment grade, and we are back to the levels we saw in the early part of the noughties, the 2006, 2005 kind of area, ignoring the GFC, which came shortly afterwards, of course. So I think there is bits there, but just watch the US government federal deficit. We've already had a rating downgrade this year. We are way over 100% debt GDP, and their interest cost is going through the roof over the next 12 months.
Luke, appreciate the update. Luke Hickmore, Mike Ontopoulos on the bond market, and a sprinkle of equities as well. Coming up in the morning calls and later, RBC's Amy Will-Silverman joins us around the opening bell on why investor FOMO has fallen dramatically. Your opening bell, 7 minutes away. 5 minutes away from the opening bell here. No drama. Negative here by just 0.1%. On a Russell on the S&P down by 0.05%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Farfetch to equal weight, $5 price target, saying a high level of volatility and limited near-term catalysts make it tough to remain bullish. Evercore upgrading JetBlue to inline from underperform, seeing sentiment improving after a punishing time for airline stocks this summer. And finally, Citi upgrading Verizon to buy, $40 price target, pointing to a more constructive investment case for large cap telecom firms. Coming up, RBC's Amy Will-Silverman on why investor FOMO is waning. Your opening bell up next. Five minutes away from the opening bell here. No drama. Negative here by just 0.1%. On a Russell on the S&P down by 0.05%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Farfetch to equal weight, $5 price target, saying a high level of volatility and limited near-term catalysts make it tough to remain bullish. Evercore upgrading JetBlue to inline from underperform, seeing sentiment improving after a punishing time for airline stocks this summer. And finally, Citi upgrading Verizon to buy, $40 price target, pointing to a more constructive investment case for large cap telecom firms. Coming up, RBC's Amy Will-Silverman on why investor FOMO is waning. Your opening bell up next. Believe it or not, back-to-back gains, a two-day winning streak on the S&P 500, on the Nasdaq as well. For both of those indexes, the longest winning streak of August. 2 days. Tells you a lot about August. Equity futures right now on the S&P 500, negative by 0.05%. No drama there. Likewise on the Nasdaq, down about 0.1%. There's your opening bell. Switch at the border, get to the bond market. Yields shaping up as follows, higher by 3 basis points. Your 10-year right now, 4. 23. In the FX market, dollar stronger, euro weaker, a break of 108, 107.85 on that currency pair, negative a third of 1%. And crude back in the 80s in the last 24 hours, up 25 cents to $80.35, up by 0.3%. About 20 seconds into the session, your equity market more broadly on the S&P 500 almost totally unchanged. On the Nasdaq, just slightly negative. One stock to watch at the open is Chevron. Strikes at its LNG export plants in Australia could begin as soon as next week. The company said this: "We will continue to work through the bargaining process as we seek outcomes that are in the interests of both employees and the company." Abby has more. Hey, Abby.
Hey, John. So what's interesting here is the stock is not moving all that much right now. It's up about 0.4%. But where we have seen wild moves is in the European natural gas market. We've seen some sympathy in the U.S. natural gas market. But today, for instance, we have European natural gas down 7%, suggesting that traders think that maybe this is not as bad as they initially had thought, because 2 days into today, European natural gas up about 20%. Lots of double-digit moves for European natural gas over the last several days, all because of the possibility of this strike. Now, relative to it happening at 2 of these Chevron plants, that's about 5% of the global LNG supply. So it is significant, and that's why we've seen these big moves, especially to the upside. They're in a dispute. The union is in a dispute with Chevron over demands around pay and some other conditions, and it will start if they're not able to meet some sort of negotiation that is successful. They will be participating in rolling stoppages, bans, and limitations, which will escalate until apparently they believe Chevron will agree to their bargaining claims. Again, that will start next week, September 7th, if they're not successful ahead of time. And right now, Chevron down just slightly. So again, not a lot of effect on the stock, but watch European natural gas. It's been on a wild ride.
Well said, Abby. What a move we've seen in the last week or so off the back of some of these stories. Just another example of how interconnected and fragile European gas supply is right now. I want to turn to earnings. Best Buy sales slump showing signs of easing with the shallowest decline in more than a year. The CEO saying this: next year, the consumer electronics industry should see stabilization and possibly growth driven by the natural upgrade and normalization of tech innovation. Simone has more. Hey, Simone.
Hey, John. Yeah, analysts were looking for a sign that this slowdown in consumer spending on personal electronics was ending, and that is what they got, with the CEO even saying that this year is likely to be the low point in tech demand. Domestic same-store sales came in ahead of expectations. They were ugly. They were down 6.3%, but the expectations had been for negative 7.3%. And in the second quarter, TV sales returned to growth in units. Unit sales of laptops were also flat, so not as bad. And back to school is a little better than expected. Holidays looking like the pre-pandemic levels, according to the CEO. Now, this relatively good consumer is not all we were looking for. We were looking for shrink. That was also positive, not meaningfully different than pre-pandemic, according to executives. But if you were looking for something negative, you got it here too. They lowered the top end of their comparable sales guidance for the year. So it used to be negative 3%. Now it's down to negative 4.5%. Really hit by appliance sales, down 16.1% year on year. The expectation had been for a little more than 10.
Stock is down 1.7%. Simone, thank you. Just what shape is this US consumer in right now? Depends which retailer you ask. If you ask Best Buy, things seem to be okay. If you ask Foot Locker or Dick's Sporting Goods, things are anything but okay based on their communication over the last week. That stock again, Best Buy up by 2% in early trading. Another earnings beat from J.M. Smucker, the company boosting its full-year profit guidance and topping estimates. The CEO saying our continued business momentum gives us confidence to increase our earnings per share expectations. We will continue to support our key growth platforms of coffee, snacking, and pet. Katie has more. Hey, Katie.
Hey, John. Yeah, shares higher this morning. And J.M. Smucker, you probably know them from Jif Peanut Butter, but I was delighted to learn that they also make Folgers coffee and Meow Mix. Talk about a balanced breakfast. Now, net sales, they were a touch soft, but shares higher this morning after the company reported a beat on adjusted sales and profit, largely thanks to both higher volumes and higher prices. J.M. Smucker said that prices rose by 8 percentage points, so that pricing power is still there, at least if you're J.M. Smucker. Now, the look ahead, it was also rosy. 2024 adjusted EPS seen at $9.40 $9.45 to $9.85. The previous range was between $9.20 to $9.60. Now, Bloomberg Intelligence had expected the sale of some of their pet food brands back in February to weigh on revenue, but you don't see that concern in the shares this morning, currently higher by about 2%, looking at the best day since June, John.
Had no idea they made pet food, Katie.
Yeah.
Meow Mix. Who knew? I'm not going to comment on cats because every time I do, I get hate mail. Just not a cat guy, for what it's worth. Just in case you're new to this program. 5 minutes into the program, equities right now positive 0.1% on the S&P 500, almost totally unchanged on the Nasdaq. Just want to get you up to speed on some breaking news in the last 30 minutes or so. This from the team here at Bloomberg. Some fantastic reporting on the Russian President Vladimir Putin agreeing to make his first foreign trip since a warrant for his arrest on alleged war crimes issued by the International Criminal Court. Our reporting, according to 3 people with knowledge of the matter, saying the Kremlin is preparing Putin's visit to China for the Belt and Road Forum in October, that Putin has accepted the invitation from Chinese President Xi Jinping to attend the event, according to one of these individuals. And this, of course, happening, this reporting, right when the Commerce Secretary, Gina Raimondo, is in China for this week. I used the word awkward in the last hour. Super awkward. Let's see what the Commerce Secretary's got to say about this particular report in the next 24 hours. Another good earnings report elsewhere. Let's talk about that from Big Lots. The discount retailer reporting a smaller than expected loss. The CEO saying this: while the consumer environment will likely remain challenging and result in negative sales in the back half of the year, we're now in a position to get back to playing offense. Isabel Lee has more. Hey, Isabel.
Hey, John, quite the bullish statement from the CEO. So the company posted a better than expected loss in the second quarter. Big Lots reported an adjusted loss of $3.24 per share. That's down 42% last year. Revenue fell 15% to $1.14 billion. So both metrics were much better than analyst expectations. And the CEO also said that while this result was optimistic, the results illustrate that we remain in a challenging environment, especially for the core lower income customers who have limited capacity in buying big ticket items. So what is the big picture here? That consumers are still squeezed. Ahead, Big Lots expects a comparable sales down in the low teen range, so that it's improving modestly from the second quarter. Now shares are up around 17%, John, so that's quite a jump.
Stock doing nicely. Isabel, thanks for that. A 17% move on Big Lots this morning. I'll get you some data on that, on whether that's the biggest one-day pop since June 13th, 2023. That just cropping across the Bloomberg right now. Amy Silverman thinking the market has reached its peak on tech and AI, saying this: only a few months ago, the biggest fear in the market was FOMO. Now the opposite is happening. We're seeing increasing signs of bearish sentiment in the Nasdaq and declining signs of bullish sentiment in stocks like Nvidia. Amy, I'm pleased to say, joined us now for more. So, Amy, that's the question you've been trying to answer. Have we seen peak exuberance in US tech? Amy, have we?
I think we have. If you look to the options market, John, it's actually quite funny. If you think to the beginning of this year, consensus was overwhelmingly bearish. And so then a few months ago, folks were forced to jump into the pool. And as we know, momentum begets momentum. You've really seen that cycle happen kind of during the pandemic, to a point where, it's not even odd anymore that we get these huge outweighings of call demand relative to put demand, and when you see that cycle happens, it takes a while to run through. But we are seeing those indications now. That call demand is really shrinking relative to that put demand, whereas that put demand is rising in mega cap tech.
Amy, you and I have talked about this a million times. It's not just about data, earnings. It's about how the market responds to those things. You mentioned Nvidia. What can we learn about how Nvidia, the stock, responded to Nvidia, the earnings, which were tremendous relative to expectations?
Yeah, it's a very interesting question. And I think you've had a lot of folks on, who've pointed to the fact that the first time we had those blowout earnings, we had a blowout stock move. But the second time we had those blowout earnings, we didn't get that blowout stock move. What I would say in relationship to that from the derivatives market is you're also not seeing that cycle of call options invert skew. So the call demand outweighing that put demand, that is a sign of that cycle continuing. And we're actually seeing that sign shrinking in Nvidia, but not only in Nvidia, in names like Apple, as well as Microsoft, as well as the NASDAQ in general. So to me, it sort of almost says, well, everyone's in the pool, so now what? And that's the question of whether that momentum flags from here.
Amy, let's talk about September then. Wrapping up August, amazing that back-to-back gains on the S&P 500. The longest winning streak of August so far, because August has been so tough. What is it about September, Amy, in difficult markets?
Yeah, so, I still like to look at the seasonality of the markets, especially for volatility. And I think because so many people go on vacation in August, people actually forget that seasonally August is actually a time where volatility rises. That also happened this year. And then September is another time for volatility to rise. You just look to, back to school in the first few weeks of the year. You have a lot of the industry conferences. You have a lot of other economic single stock and macro data happening, and just physically more volume coming through. I do think we'll see another environment where you're not only going to get that volatility rise, but going back to everyone's in the pool now, you do get that question of, is it time to hedge with only a few months remaining before we close the end of the year?
I'll ask you that question right now then. Amy, it's paid off big time to be long the S&P 500 year to date. You know that. Everyone does. Do you think it's going to pay off to lean the other way?
I struggle with this question, John, because usually, I can point to options and say, look, these option strategies have been so attractive. Unfortunately, if you look to date at every single option strategy, you've actually just been better off being along the S&P. I don't like to have to say that as equity derivative strategist, but it is true. I do think there is an inflection happening because it always comes down to positioning. And if you have people now who have benefited from that FOMO and have benefited from that rise in mega cap tech, I think the question they're asking themselves now is, do I protect my portfolio? Which was not the question they were asking perhaps a few months ago. So you could see that demand rise for hedges.
It's a change. Amy, appreciate the honesty as always. Amy, Will Silverman there of RBC. We're about 11 minutes into the session. Let me give you the wrap up of things right now. Potentially a third day of gains on the S&P. Really mild muted stuff though, up by 0.1%. A very, very small move lower on the Nasdaq by 0.05%. Outside of that, into the bond market, 2-year yield still just about 5%. Up by 2 basis points today to 5.02%. A sixth day yesterday, the 2-year closed above 5%, a sixth consecutive session. Let's see if we make that day 7. So yields a little bit higher, dollar a little bit stronger, push through euro right now, and you see euro dollar at 107.95. We're negative by 0.2% on that currency pair. Coming up on this program, banking in focus as the FDIC explores new regulations.
50% of the S&P is above the 200, 50% is below. It's a very, very split tape. What I don't like is on the wrong side of the split tape, you have some pretty important groups like banks.
But a tough month for the banks, even with that sell-off in the Treasury market. Typically we talk about higher rates helping out the banks. Not this time around. We'll talk about that next.
You go name by name. It's just odd to me that Citigroup is back on the lows, Bank of America's right there, Goldman and Morgan Stanley look weak, and we know the regionals have rolled. 50% of the S&P is above the 200, 50% is below. It's a very, very split tape. What I don't like is on the wrong side of the split tape, you have some pretty important groups like banks.
It's been a tough month for the banks on the S&P 500. Chris Ferro there, Strategas, weighing in on the banking sector. The banks, the post-SVB high, a couple of months or so ago, we're down about 9% from there. Bit of news on the banking sector overnight. The San Francisco Fed's banking supervision chief, Azar Abbasi, announcing his October retirement. He had oversight of failed lender SVB during its collapse. This is the FDIC is set to meet today at 10 a.m. Eastern time, so about 15 minutes from now, likely to propose new rules requiring mid-sized lenders to issue sufficient long-term debt to cover capital losses. Your team coverage starts right now with Bloomberg's Mike McKee and Shanali Bassett. Mike, some moves at the San Francisco Fed.
Yeah, this is not being explicitly linked to the bank failures earlier this year, but it is certainly not a surprise that somebody might be leaving the bank. As you mentioned, Azar Abbasi was Executive Vice President of Supervision and Credit at the Federal Reserve Bank of San Francisco. He was responsible for the group that was overseeing SVB. SVB obviously went down in flames, and Michael Barr, the Vice Chairman for Supervision at the Federal Reserve Board, put some of the blame on the San Francisco Fed, but also some of it on the board in Washington. And he has promised reforms that will try to bring the two sides closer together, the two enforcement groups closer together, and also change some of the supervisory practices that are used to try to keep the banks out of trouble. So again, Aja Abbasi was in charge of the group. He is retiring. People can make the conclusion that they want.
I think people are drawing some of those conclusions, Mike McKee. Sonali, it's been a number of months since these banks failed. We've spent the last 3-4 months talking about what next on the regulatory front. This FDIC meeting that starts in about 12 minutes' time, Sonali, how important is that?
It's very important because we're watching rules that are hitting banks with $100 billion of assets or more face regulations that they have not seen in many, many years. Now, remember, when you take a look at what's actually happening today on top of the Basel III requirements, you have the United States, the FDIC, wanting them to increase their long-term debt requirements. The reason they're doing this, John, is because you're watching an issue here with the Deposit Insurance Fund taking a hit this year with those bank failures. And you're watching the chair of the FDIC say no more. We want to make sure that this does not happen in the future, and they want to avoid the systemic risk exemption. So what does this mean for the market? It means that the banks could face about $157 billion shortfall, according to analysts at Bloomberg Intelligence. U.S. Bank, PNC, Truist, the most exposed among those banks. Now, New Edge Wealth, Ben Emmons makes an interesting point here in an email to me this morning, which is that these banks, many of the system right now is still on life support. Bank borrowing from the bank term lending facility over at the Federal Reserve to the tune of over $100 billion. Now, in addition to that, they're going to have to increase their borrowing and therefore their borrowing costs at a time where you're also facing a lot of downgrades for the banking system.
Sonali, this is the mid-sized banks. What about the big names we're all familiar with, the JP Morgans, Bank of Americas, the Citis of this world?
Well, they also face more rules by means of Basel III Endgame. They are in the process of fighting a lot of those proposals. But you also have to take a look at not just those. Let me take a contrary point of view for a moment here. You have Wells Fargo pointing out the banks under $100 billion in assets here that might face less regulation, that might become more attractive in the future just because of their pure size and ability to cater to smaller markets more directly. But to your point here, the big have only gotten bigger in the midst of this crisis. They will also face more rules, but they also have more money to set aside here and lower borrowing costs in order to weather these new regulations better than those mid-sized banks above $100 billion in assets.
Mike McKee, we've both just returned from Jackson Hole. You were there through the weekend. I think maybe once this came up in conversations. Can you imagine that back in spring if I said we'd go to Jackson Hole at the end of August and it would be barely talked about? Those banking failures.
A lot of people were expecting it to be a systemic problem that spread throughout the banking industry, but it didn't. It was confined to basically the 3 banks that went under at the time. And it does seem to show that even with the problems that the bank supervisors have, the U.S. banking system is in much better shape, much stronger than it was certainly in 2008, 2009.
Mike, before you run, I want to squeeze this in just on home prices, just quickly. Home prices in the US, according to the data this hour, climbing for a 5th month. Mike, where does this leave the Fed's effort, given what we know is happening with the mortgage market and how nuanced, unique, idiosyncratic, dare I say, the situation is?
Well, it's kind of an interesting situation because prices are going up, but nobody's buying houses, really. That's why prices are going up. It's a supply-demand issue. So if we aren't seeing a lot of turnover, even if prices are higher, it's not going to have the major impact it would have, say, when we saw in 2005, 2006, when home prices were going up so much and they created a bubble. So it is a concern in terms of the long-term health of the housing industry, but not a major concern for inflation right now.
Mike McKee, thank you, sir. Alongside Sonali Bassett, the latest on the economic data, housing prices and the banking effort, the regulatory effort, which is going to kick up into high gear in about 9 minutes' time. About 21 minutes into this session, your equity market looks a little something like this. Third day of gains potentially on the S&P 500. The session is young, so early days here. On the NASDAQ, potentially a third day of gains as well, up a third of 1% on the NASDAQ. Into the bond market, yields a little bit higher at the front end of the curve by a basis point or two, just north of 5%. And in the FX market, the dollar just a touch stronger against the euro. The euro in the last couple of seconds just about reclaiming 108. Let's get you some sector price action. Here's Abby.
Well, John, if we do get that third day higher, it will be the first time we'll have seen that in the month of August. It will be the best 3-day stretch since the middle of July. As for what's happening on the day, relatively small moves, as you pointed out, early times in the day. But we have some of those mega cap tech sectors up top, discretionary, along with communication services. Very small losses on bottom, energy, real estate, industrials. If we take a look at what's happening on the month, though, because it is the worst month of the year for the S&P 500, 10 of the 11 sectors are lower. Energy remains the one sector that's higher. And of course, we do have some of that volatility in natural gas that we were talking about earlier, driven by the LNG strikes. But take a look at the financials that you all were just talking about, down 3%. Materials down almost 5%. Utilities, that is the worst sector on the year, perhaps having to do something with Hawaiian Electric, but also with yields higher. Well, those dividend-rich stocks, they just don't look as attractive, John.
Getting beaten up by treasuries over the last month. What a move we've seen, particularly on the 10-year yield, not just the 2-year. Abby, thanks for that. Coming up, tons of jobs data in America. Your trading diary up next. Three-day winning streak on the S&P 500, the longest winning streak of the month so far for the month of August. As we wrap up this month and look ahead to September, about 25 minutes into the session, advancing by, let's call it, 1/4% on the S&P and about 1/2% on the Nasdaq. There's the price action. Here's the trading diary coming up. FDIC board members meeting at the top of the hour on new banking regulations. We'll also get job openings data and consumer confidence. US GDP numbers coming out on Wednesday. Another round of jobless claims. And the PCE deflator coming up on Thursday and Friday. It's the main event, drum roll, into Friday before the long weekend. If you stick around for that, it's payrolls Friday, this Friday. And the expectation in our Bloomberg survey, the median estimate so far, 170,000, just down a little bit from 187, as the Fed would say. They call that progress. Further signs of progress in the labour market, trying to take some heat out of this, reduce inflation and engineer that elusive soft landing, whatever that looks like. That does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.